I'm going to recognize the gentleman from Texas for his opening statement.
Thank you, Mr. Chairman. I appreciate that very much, and I appreciate you holding these hearings that I request. I think these are very important hearings and a very important subject as well. First, I'd like unanimous consent to submit a written statement into the record. Thank you. But I think what these hearings are dealing with is the essence of inflation. Everybody knows there is inflation out there, and nobody likes it, and everybody wants to take care of it, but they don't talk a whole lot about where it comes from. But if you do a survey of economists, whether they're conservative or liberals or monarchists or Keynesians or whatever, almost all economists recognize that inflation is related to a monetary phenomenon. And they seem to agree with that, but then they don't dwell on the monetary phenomenon. They dwell on the prices. And today, of course, people aren't very happy with the price of oil and energy, and they talk about obscene profits and not enough drilling and too much demand in China. And these factors may well play an important role. But supply and demand of the oil is one thing, but nobody really talks about the supply and demand of the dollar. And if the dollar goes down in value, that's going to push prices up. And we don't talk about that a whole lot. A lot of times people, when they think about this issue, they talk about an economy when it gets heated, that they have to turn it off. A heated economy is bad, so they purposely tighten the money and raise the interest rates to turn off the heated economy. But in reality, if you have a sound, healthy economic system and it's vibrant and heated, actually that's very good. There's a lot of growth. And what happens when you have a lot of growth? Prices go down. So it always seems so foolish to me when people talk about a heated economy and they purposely look at the prices and say, well, to get the prices down, we have to penalize the economy and turn it off and turn off the spigot. And that, of course, isn't the way it works if you have a sound dollar, and that is something that I've been talking about for a long time, and I'm so glad that we're able to pursue that a little bit and relate higher prices to the monetary phenomenon. And if this is the case, if everybody agrees that it has something to do with the monetary policy, and we don't like the consequence, which are the higher prices, in many ways it's semantical, because 99% of the people, you talk about inflation, they think, oh, the CPI is going up. But those of us who concentrate on the monetary system say, well, inflation comes from the increase of the supply of money, artificially low interest rates, malinvestment, and artificial financial bubbles that need to be corrected by bringing up, a recession. And I think we have a chance today to talk about that issue and see the relationship between money and prices, and that just drilling isn't going to be the answer to a problem which is basically monetary. So once again, I want to thank the chairman for holding this hearing, and I welcome the panel. Thank you, Madam Chairman. My question is directed toward Mr. Williams and Mr. Murphy. And it has to do with talking a little bit more about the weak dollar. I think everybody's talking about a weak dollar having an effect. Some say a lot, some say less on the prices. But my basic assumption is that, and I don't think it's hard to argue, that if you create a lot of new dollars, the value has to go down. Unless some people argue, well, if production is up, we might be able to, stave off some price increases. But if the money supply goes up rapidly, if we increase the money supply by 2 or 3 times immediately, the value of that money is going to go down, and prices will go up. And, of course, that's the subject we're dealing with today is, does the money supply increase? Has the money supply been increasing? In 1971, there was some restraint on the Federal Reserve to create money out of thin air. Not much restraint, but there was some. Tell me a little bit about what's happening, not only with oil, but commodities, because, in one sense, we're talking about oil, but we're really talking about the value of dollar related to commodities. What has happened with the money supply since 1971, and how has that affected our prices? Is this significant or not? And, and how should we measure this? There was a time that we measured this by M3, the total money supply. The Fed creates money to help the politicians, cover up their debt. They monetize debt, and then we have fractional reserve banking. And then when all that happens, we used to measure it. It was called M3, but we don't even have this. But some people still like to have that number and think about the relationship of all this money, prices today specifically dealing with the price of oil. Could you expand a little bit on that, on this pressure we put on the Fed to monetize debt and fractional reserve banking? What's happening to the money supply? Is M3 important? What is this relationship?
Sure. What has happened over time, and indeed with the general monetary theory, the definition of inflation is basically an increase in money. If you look at the traditional equation on it, it has the level of money times its velocity, which is the number of times the money turns over in the broad economy, equals the nominal GDP before inflation adjustment, which was effectively a constant dollar measure, a physical measure of the economy, plus the rate of inflation. So that the inflation, if you rework the formula, is pretty much a function of the growth of the money supply and velocity. Unfortunately, it's very difficult to come up with meaningful measures that fit into the theory. I believe the theory is correct. I think that's been demonstrated over time. But I'll contend that you do not have a measure of the GDP implicit price deflator, or even a measure of the money supply that actually fully reflects theory, accounts for everything that's happening in the world. It's very difficult to move from theory to the real world. In terms of M3, though, that has been the broadest measure over time. The Fed stopped publishing it a couple of years ago. I've continued to track it, estimate it, largely using Federal Reserve numbers. What we're seeing right now is that M3 as the broadest measure, which I believe is the best predictor of inflation, is up as of June year-to-year 15.8%, very close to 16%. And now that's off its peak of 17.4% back in April. But shy of the current period, the last time you saw anything close to that was back in June of 1971, when M3 growth on a year-over-year basis hit 16.4%. That was 2 months before President Nixon closed the gold window and imposed wage and price controls. Now, if you want to predict inflation using the money supply, it's difficult to do it from a traditional theoretical standpoint. Over the last 25 years, I've worked in terms of coming up with practical ways of predicting inflation, interest rates, and economic activity using a variety of indicators that have leading relationships to what I'm trying to predict. I found over time that with the money supply, the broadest measure you can use will generally give you the best result in terms of what's going to happen to inflation. And what we're seeing with M3 right now suggests that where the official CPI is being reported year over year at about 5.0%, could be in double digits.
Time is expired.
2009.
Mr. Chairman.